This explainer. Today, we're basically sitting down for an exclusive analyst briefing where we're pulling back the curtain on how institutional smart money actually dominates the financial markets. We're going to look at the market purely through the lens of an institutional analyst. That means we are completely shifting our focus away from all that everyday retail noise and looking straight into the actual mechanics of order flow and liquidity.
So, let's start with a scenario that I know frustrates pretty much every intermediate trader out there. You're looking at the charts, and you spot what looks like an absolutely perfect trend reversal. You execute your trade, you carefully place your stop loss, and then, boom. Almost instantly, the market snaps back in the opposite direction, stops you out, and then continues exactly the way you originally predicted. I mean, we've all been there, right? Why does this happen so incredibly often? Why do so many of your trend reversal trades just end up being traps?
Well, the answer really comes down to fundamentally misunderstanding market mechanics. See, what you think is a reversal is very often just a liquidity grab. This is a totally intentional move, engineered by the major players simply to trigger retail stop losses. They are quite literally creating the liquidity they desperately need to fill their massive orders. And this is completely distinct from a true institutional market structure shift, which is an actual fundamental change in the market's dominant trend.
So here is our game plan for today. We're using a top-down analytical framework to map out exactly how institutions read market intent and execute high-probability trades. We'll quickly cover thinking like smart money, decoding market structure shifts, tracking institutional footprints, capitalizing on price gaps, finding precision entries with Fibonacci, and finally, wrapping it all up with a high-probability trade checklist.
All right, let's kick things off with Section 1, Think Like Smart Money.
If you want to stop getting trapped, you've got to fundamentally change your perspective. Stop guessing at retail direction and start analyzing the institutions that actually dictate the flow. This means mastering smart money concepts, or SMC. When we say smart money, we're talking about the massive capital controlled by professional investors, market makers, central banks, you name it. These entities trade in volumes so unimaginably huge that they can't just click buy or sell on a whim without causing massive, crazy price spikes. They literally have to engineer liquidity. They have to induce retail traders to take the completely wrong side of a trade, just so they have someone to buy from or sell to. So, our goal? We have to let the retail market provide that liquidity, and we align our own positions with the big banks instead of fighting against them.
Moving right along to Section 2, Decoding Market Structure Shifts.
Okay, so to figure out how smart money signals a genuine change in trend direction and not just another fake-out, we have to look for a true market structure shift. Imagine a clear uptrend, right? Higher highs, higher lows. But then, unexpectedly, the price just aggressively plummets below the most recent lower high, creating a lower low. Now, what makes this an authentic shift and not just a liquidity grab? It's all about displacement. Displacement is this rapid, incredibly high-volume movement. You'll often see it as these large, full-bodied candles that leaves absolutely no doubt about the bearish intent. It's the market screaming that major players have aggressively stepped in and flipped the sentiment.
Once we spot that shift, we're immediately looking for a break of structure, or BOS. If the market structure shift is your initial warning siren that a trend is changing, the break of structure is the validation. It confirms that this new institutional trend is actively continuing. It happens when the price decisively breaks and closes past the next key swing point in the direction of the new trend. Seeing consistent breaks of structure is exactly how we confirm we're staying perfectly aligned with the dominant institutional flow.
All right, let's jump over to Section 3, Tracking Institutional Footprints.
Now that we've got the macro structure down, let's zoom in on the micro view to find the exact setups and footprints left behind by these massive institutional orders. And the ultimate footprint here is the order block. An order block represents a specific zone. It often looks like a brief little ranging market or a consolidation right before a massive move, where the major players were quietly accumulating or distributing huge quantities of an asset. Basically, they're building up their position right before aggressively driving the price through a structural break.
But you got to be careful here. Not every random consolidation is an order block. As analysts, the data tells us we only care about high probability zones. A valid order block absolutely must trigger a structural shift, which we often call a change of character. It should also have retail liquidity, like a bunch of stop losses, built up right before it, which the institutions then sweep. It has to leave that clear displacement behind, and when the price eventually comes back to it, it should aggressively reject that zone. You see, volume and these specific structural clues are what actually confirm true smart money intent.
Let's move to Section 4,
Capitalizing on price gaps.
So, along with order blocks, institutions leave behind another very distinct signature when they enter the market with extreme aggression, and that is a fair value gap, or FVG. When an institution injects massive volume to create that displacement we just talked about, the price jumps so incredibly fast that it leaves a literal gap where no trading occurred. This creates a zone of price inefficiency, and here's the thing, the market absolutely hates inefficiency. Because of that, these fair value gaps act like giant magnets. Institutions will very frequently let the price retrace back into this gap just to rebalance their positions before the trend continues. For us, that right there is a prime target for a high probability trade entry.
Okay, Section 5, Precision Entries with Fibonacci.
Once we see the structure shift, locate the order block, and spot that fair value gap, we need a precision weapon to pinpoint our exact entry trigger. Enter the Fibonacci retracement tool. But we are using it way differently than your average retail trader. Retail traders typically try to buy these shallow pullbacks at the 38.2% or 50% levels. Institutions, though, they are patient. They want the absolute best possible pricing, so they'll often drive the price down into what we call the deep retracement zone, which sits between the 61.8% and 78.6% levels. We actually call that sweet spot between 0.618 and 0.65 the golden pocket. But listen to this. Your absolute highest probability setup happens when that deep 0.786 retracement perfectly overlaps with an order block and a fair value gap. When you see that convergence, that is literally where the magic happens.
Finally, Section 6, the High Probability Trade Checklist. All right, we've covered a ton of advanced institutional concepts today. So, let's synthesize all of this data into a ruthless, step-by-step playbook to filter out all that market noise. Step 1. Define your higher time frame trend and wait for a clear break of structure to confirm the direction. Step 2. Look back at the origin of that move and locate the order block and the fair value gap that caused the aggressive displacement. Step 3. Draw your Fibonacci from the swing low to the swing high to identify your deep retracement zone. And finally, Step 4. You wait. You simply wait for the price to efficiently return to that overlapping zone, you look for a rejection candle, you execute your entry, and you place your stop loss safely behind the order block. By strictly following these 4 steps, you are aligning your capital with the dominant flow and executing with the icy discipline of a senior trading desk analyst.
I want to leave you with this final, highly impactful thought. Amateurs react to every wiggle, professionals wait for the structure to shift. You've got to stop trying to trade the noise. Stop letting your hard-earned capital become the liquidity that fills institutional warders. Instead, just wait for the definitive footprints of smart money. So the very next time you sit down to place a trade, ask yourself, are you riding the wave of smart money, or are you just providing the liquidity they need to crush you?